A lot of people are saying you got to watch the leadership for signals about the broader market, but you disagree.
Oh, I totally disagree. I mean, the Magnificent Seven, that game's over. Okay, the boat's already sailed.
I feel like, it's becoming a bit of a broken record. I mean, we have you on. Tech stocks go up. NASDAQ extends its record high.
Last year and a half, they've added $8.8 trillion in market cap, just these 7 companies. Just to give you perspective, the second largest market in the world, China, is a market cap of $12.1 trillion.
We are well into the bull market. Indexes continually making new highs. Lots of wealth has been made this year, particularly in the Magnificent Seven companies. Big tech.
Big tech is very interested in the big potential this technology promises.
If you're going to do AI at the frontier, you need to be partnered with Microsoft or NVIDIA or Google or one of the big players. There's just no other way. They have resources that nobody else has, even governments.
Which has been pushing the S&P 500 and NASDAQ indexes up with them. But how sustainable is this rally? Is the rally in tech and AI overhyped? Well, not so fast. There are a couple reasons why the tech rally could continue in the short to mid-term. But stay with me. I'm going to discuss why the tech rally may not continue in a longer time frame. In the longer time frame, I'm meaning a year or two from now. I'm going to go through data that we're seeing that could bring the end of this bull market overall. Data that the Fed is looking at in regards to making interest rate decisions, but they don't want to talk about these things publicly. Big tech has been rallying for a few reasons, not just the AI hype like the market likes to chatter about. Biden's policies benefit big tech the most. Now, Biden's history of close Wall Street ties go back quite a bit. I don't know if you guys, or even if he remembers this, but he was a powerful player in Delaware. You know, where the biggest companies in the world are incorporated. We go back all the way to Obama. He has kept policies left on by Obama, even Trump, that massively favors big tech and tax treatment, trade agreements, even censorship. Biden is known to have very close relationships with Apple's very own Tim Cook. Yeah, the guy that runs the biggest company in the world. He also is close with Satya Nadella from Microsoft, Sundar from Google, Zucchini, and yes, even Elon Musk, despite what you might see on Elon's PR Twitter machine. By the way, speaking of Tesla, Tesla's stock has turned into a meme stock now. Now, bad company fundamentals are irrelevant, just like GameStop. So we'll have to see how long that plays out. But if Elon really wanted Biden out, he would be backing Trump, not Kennedy. Now, the tech sector ETF, being the best performing sector out of all 11 sectors, is up 24% so far this year. Meanwhile, the average sector performance is only 8.7%. So that's almost more than double than the rest of the market. So while market participants may have thought the tech rally, particularly the AI rally, has become unsustainable, they've been saying that all year long, and probably now are feeling FOMO as they continually to see those companies make new all-time highs. As you can see here, the semiconductor sector is in the blue, and in the orange is NASDAQ 100, and in the yellow we got the equal weighted Dow index. Now we can see the rest of the market is not in line with this recent tech rally exactly. Now it's also important to note the spread in market cap and net income in the top S&P 500 companies is wider than we've ever seen before. Now, sure, the tech rally is due in part to the potential growth they might have in the future. The market's pricing that in now. But we should also consider that if the tech rally continues, that could be an indicator in of itself that Biden and co. will get a second term. Now, recently, Apple rolled out their $110 billion stock buyback program, driving the company's stock to new all-time highs. Maybe they know something. Maybe they're anticipating that Biden will win again. Now, let's look at the macro and the 40,000 foot view outside of just tech. What's pushing markets up besides the tech rally? Well, recently the US net liquidity has risen by about 270 billion in just a week's time. Now, the Fed may lower rates once this year as well, and the markets have been pricing that in. So, for that reason, I'm still positive on my outlook for the rest of the year in the market. However, the timing of the rate cut from the Fed, it may not be soon enough. The Fed got what they wanted, and that is cooling CPI with hiring rates. However, we could face the cost of that. Supply chain and services activity is slowing, both of which haven't been this slow since April 2020. Now, we're also seeing a trend of rising unemployment recently, particularly weak private employment. Meanwhile, wages have risen 3.9% year over year. So it's not exactly great for small businesses. So we can see inflation has come down, but that means that the economy is starting to cool off, and this trend may continue down. This all could slow down the economy in the next 6 to 12 months from now. If this trends in these data points continue, we'll have to see. Now, we're seeing the personal savings rate at lows we've seen only during recent recessionary times. Now, I'm not saying that this is a perfect indicator of any sort to track, but if we zoom this data out over more years, we can see that this might be irrelevant. However, I find it interesting. Now, I'm not a doomsdayer by any means. In fact, I'm infamous for being a bull the last year and in 2023, calling for the 2023-2024 bull markets and calling out the perma-bear doomers like Peter Schiff. However, if the trend in the data in the leading indicators continue this way, well, if that happens, GDP could go lower in 2025 and 2026. So recession now is not off the table coming in the long term. So the Fed is in a tough position. And we can argue all day about what they did wrong, what they should have done. But if they lower rates too soon, inflation could creep back in. And if they don't lower rates soon enough, we might see the average American and small business owner be hurt more by that, resulting in economic growth turning sour further. So you'll probably see the market in 2024 continue to make all new all-time highs, especially in anticipation of the next rate cut. But if you've been around the channel long enough, you might remember, despite the hype about rate cuts happening all of last year, I said the Fed was unlikely to do so in 2023, and probably the rate cuts would probably be closer to 2025 through 2026. And my mind has not changed on that so far. Now, as far as the dumb money is concerned, everyone panic sold and we're freaking out in 2021 through 2022. And then they got major FOMO in 2023, so they started buying again. Now, most people are thinking that the markets will go higher recently. If we know anything about dumb money, let's just say overall their timing isn't exactly great, although they may not be wrong in the near to mid future the rest of this year. If you're a long-term investor in markets, I wouldn't sell everything just because of this presentation or data presented. However, it might be prudent to take risk hedging measures. Again, I'm not a doom and gloomer. In fact, I see a lot of opportunities in trading the markets now in the next coming months. However, traditional long-term market participants, they may be disappointed in 2025 through 2026 if these trends continue.
On July 19th, I'm hosting a free workshop called How to Become Your Own Hedge Fund. The industry holds closely to their vest. I'm going to divulge for you guys in this upcoming free workshop. I hope to see you inside.
Those of you who get access to this workshop will receive the Smart Money Trading Glossary a week before we go live. Aloha. Now you can learn more about how I'm positioning my book in light of all of this in the link below. By the way, no, this doesn't mean I'm setting up to be the next Michael Burry, shorting everything. Nor does it mean that I'm YOLOing NVIDIA. So that's what I'm seeing in the macro for the rest of this year and the potential headwinds we could face next year or so. Now I'll keep you guys updated as we get further along. Did you like this video? First, I want you to comment below your thoughts and any ideas or topics you want me to cover in upcoming videos. Second, be sure to like this episode as it does help the channel. And lastly, YouTube is recommending that you'll find this next video interesting. So I'll see you in the next one, and until then, bye for now.